Okay.
Excellent, excellent, excellent. Well, like I said, thank you all so much again for joining us. And I'm going to jump in because we're running just a couple of minutes behind, and I want to make sure folks have all the time in the world to ask Jeri all the questions. I have a very long list of questions that I could ask her, but I want to leave time for you all too. For those who have not met me yet, I do see a couple of new faces here. I'm Vanetta Young. I'm an investment readiness advisor, working with primarily women and people of color emerging managers in private equity and real estate, those who are starting their first fund. And so it is my absolute joy to bring together this community of emerging managers and folks who support emerging managers. And I wanted to invite Jeri here. She and I met at a conference a little while back, a virtual conference a little while back, and I'm just so impressed with her experience. If you know me very well, you'll know that I worked at the SBIC program when I was in business school at Georgetown. And that was actually my big introduction to the world of institutional limited partnership and private equity due diligence. So, and also where I sort of learned the concept of emerging managers and sort of really fell in love with the space. And so I'm going to read a little bit of Jeri's bio, and then I'm going to jump into the questions. So Jeri Harman is the founder and chairman of Avante Capital Partners with over 840 million in capital under management across 3 funds. Avante makes debt and equity investments to finance buyouts, minority recaps, acquisitions, and growth. In 2020, Avante was named one of the most innovative commercial finance companies by ABF Journal. And in 2018, Avante Mezzanine Partners was named SBIC of the Year by the U.S. Small Business Administration and Women-Owned Firm of the Year by PE Win. So the impressiveness continues. Please, I will send you the rest of Jeri's bio. But Jeri, thanks so much again for being here with us. And just want to start out, even though I just read a little bit of your bio, if you can just give us just a little, the sort of overview of your career and how you got to where you are, preferably ending with what, in your opinion, was the reason, how did you become SBIC of the Year?
Okay. So it's a pleasure to be here with all of you. You know, sounds like you're all interested in, our emerging managers are interested in being one. And I've been there and am that, so to speak. Happy to share whatever I can to be helpful along this journey in this call. In terms of my career path, I've been involved in the private credit, private equity world for over 35 years. I got my MBA at Berkeley, and then my first foray into the field was with Prudential Capital, large insurance company investor, where we provided both debt and equity, pretty much the same thing I do now, to middle market companies. In those days, we did also, control buyouts. We called them bootstrap financing in those days, just to date myself. Then I did some investment banking, and then got back on the buy side when I was recruited to American Capital, which was one of the large BDCs, business development companies, multi-billion company, to start up their LA office, built the team, built the market presence, built the portfolio. And 4 years later, I was recruited by Allied Capital, the other big publicly traded BDC at the time. And in the Allied's case, I was responsible for the entire Western US and on Allied's investment committee. Then 2008 hit. Everything changed for many people who are in the investing world, including myself. And all the publicly traded funds started closing offices and retracting to a certain degree. And it was a great time to think about doing something else and controlling my own destiny, which is usually what emerging managers want to do, right? You want to have your own business and control your own destiny. I had a great track record, which Allied gave me, which was great. The CEO and chairman of Allied was a reference. So I had that track record, pulled together the team, and we launched Avante in 2009. Raised our first fund, first close in 2010, and we were off to the races. Had a final close in 2011. So the first fund was 218 million. We raised our second fund in 2015 with 250 million, and we're just finishing raising our third fund with 373 commitments, with one more investor that may come in to bring us over 400, but we're pretty much way oversubscribed. So that's a little bit of the history. If that's what you're looking for.
Yes, wonderful. And actually, yes, I am curious as to, knowing that sometimes the process of running a fund or raising a fund can be very sort of opaque. But the SBIC program is very much also sort of in that opaque realm too. But what do you think it was about your team or your experience? What do you think it was that sort of made you all stand out among the rest to become SBIC of the year?
Okay. Yeah. Sorry, I didn't answer the second question.
No problem. No.
Keep me on track, Vinny. I think, well, first and foremost, performance, right? I mean, our first fund is top decile right now. I was then. Second fund is on track to certainly be top quartile. So we've had very good results, very consistent results. I think another aspect is compliance. Within the SBIC program, there's a lot of rules, and you have to be kind of a good citizen, so to speak, by obeying those rules and keeping between the lines and being aware of what those restrictions and rules are. And and it's not impossible to understand them, certainly, and to abide by them. So we were, our compliance, and they audit you every year, by the way, that a separate audit from the SBA. And so we always had clean audits and, and all of that. And then I think third, and these aren't necessarily in this order, but, was frankly our diversity. We are 100% women owned, really women and minority. One of my co-owner partner is Latina. We have at this point 16 team members. 12 of our 16 are women, minorities, or both. At the time, we had a smaller team with the same kind of diversity, and I think they really liked that. And we were also very involved in the industry. I got involved with SBIA, Small Business Investor Alliance, which is the National Association for SBICs, and also small private equity funds. And so I became involved on the board and eventually became chair of the board of the SBIA. I'm an ex officio board member now because I'm past chair. But that got me very involved with, the industry and interacting with people. The SBA, I got to, develop some very good relationships with people there. So I think it's all of the above. The only way to even qualify, of course, is performance and compliance. Right. And then after that, it's all these other more qualitative things, I think, that put us over the edge.
Definitely. And I'm very impressed with the stat that you just threw out, that 12 of 16 people on your team are diverse folks. And I know that this can be a little bit of a sticky issue in the industry, particularly as people have this belief in the pipeline problem and et cetera, et cetera. But practically speaking, what did you all do to attract and retain diverse board members? I'm sorry, team members.
Yeah, we do board stuff too. I'm on the board. We're diverse there too.
I am 8 months pregnant. I am so happy my brain is functioning at all.
I completely understand and been there and done that. So I think, first of all, when you start diverse, you have an advantage of attracting diverse people, right? So we're starting right away with the founder being a woman, right? And then, they already could see other role models in both, in however one define diversity. So that's always helps, but you've got to, most of the firms in the industry are all white men. So that's, that's harder starting point then, even if all the right intentions. But I think the first thing with recruiting people with diverse backgrounds is to be intentional. I mean, it is not just, you can't do the regular recruiting methods and expect, you can't keep doing the same thing to expect different results, right? And if you keep fishing the same pool, you're going to get the same kind of people. And so, being intentional is really going broader and looking at, people with different non-traditional backgrounds, still the skill sets you need, but maybe more non-traditional backgrounds, and be willing to embrace that.
Yeah.
So, and we've done that. Does it require a little more effort and maybe some more training? Yes, but the results, are fantastic. We have a great team of people I would stack up against anybody in the industry, and her performance reflects that, because it's all about the team. So, and then it's also about culture, because attracting the right people, if they're really talented, they have choices, right? And when you have choices, you're going to go to the place that feels right, that's going to offer the best opportunity, of course, in terms of excuse me, career path and learning, and those definitions of success. But you want to feel like you fit, and you want to feel like you're going to be embraced, and you want to feel like you're going to be supported in that career path, and that's part of culture.
And speaking of culture, when Jeri and I talked, she recommended this book to me, The Culture Code, which, yes, I did go purchase. And even though I'm a writer and I do support the literary arts people are very much about independent bookstores, I did buy it on Amazon because I am also a business person, and that was just a good business decision. So I also recommend this. Jeri said that she and her team read it, and it was very much a game changer. And I actually could not agree more. One of the things that the author, Daniel Coyle, talks about is this idea of psychological safety. And I think that's really, really intriguing, and is even more important when you have a diverse team, particularly when you have women and people of color on your team. What do you think you did to create an environment of safety at Avante?
That's a great question. And just to be clear, for all of you who probably don't like or have never read a self-help book, which is the case for me until my partner, Emelise, who's big into self-help books, recommended this book and a few others, and I respect her a lot, so I read them, and it was great. As you said, it's a great book. But it's not to say that I'm out there reading all these books all the time. So in terms of creating an environment of safety, I think it's a number of things. First of all, for us, we have a core value of mutual respect. And I think a lot of it starts there. And those things are felt and can be observed. We also have very open and transparent dialogue at all of our meetings. So, again, another behavior, right, that can be modeled. And we really our whole culture is about focusing on the team and group success while supporting people individually in their own growth and career paths. But when it's about the team and not about the individual, the team is the most important. It creates a different dynamic, right? It's not a bunch of prima donnas or superstars and things, even though everybody we feel on our team is a superstar, right? But I think one of the other things that isn't always done that helps create an environment of safety, and it took me a while to learn this, honestly, it isn't the way I managed initially, but it kind of evolved over time, is to recognize and celebrate different ways to contribute. You don't have to have the same checklist for everybody and say everybody has to be great at all these things. For example, two of my partners, Evelise and Paul, who both started me as VPs. Evelise is now a managing partner, my co-owner, and Paul is one of our very important partners, amongst others. Everybody's important, but one of them. Paul, super analytical. I mean, unbelievable. Really thinking through all the analytics and, part of the diligence and assessing an investment opportunity. One of his superpowers. Can he do everything else? Yeah. Is it the other things his superpowers? Debatable. Evelise is amazing at developing relationships with people and originating, right? She's a great deal person. She has great deal judgment as well. But her superpower is, marketing strategy, origination, making people want to work with her. So when we go after a deal, she's on it, there's a good chance we're going to win it. And she has good instincts and what to do that, right? And so when you put those two together, and as VPs, rather than competing, they supported one another. She recognized his strengths and said, help me on this. He recognized her strengths. She helped him on that. The two of them, our reason we're where we are, along with the rest of the team. So it's embracing each of their superpowers, not criticizing where they're, not as strong. They have to be adequate in other areas, obviously. But
Right.
I think when people feel like, okay, I'm really good at this, and I'm not going to be, given a fail because I'm not as good at some of these other things, as long as I'm good enough. And we want to make sure we support them and train them in the areas that, they can use further development. And everybody does. I need further development, throughout my career. We all do. We're all growing, right? We're all figuring out where we can get better. So I think that's something that is and the bar is still high. This is not lowering the bar. We have a very high bar, but it's just the way you recognize contributions, right? And that way everybody feels important in some way, and they support each other rather than compete with each other. And then the final point I would make on this, culture of safety is that we show our own vulnerabilities. This may be because we're women, maybe because we're diverse, it may just be because of who we are. I mean, it could be different. But we really show our vulnerabilities and demonstrate that and how the partners treat each other, how we communicate. Because it starts at the top, right? If we're sitting there bickering and not being respectful to each other and holding it like a big shield in front of us, so we're not admitting our mistakes and not showing we can be vulnerable and be okay and safe, then why would anybody else, right? If we're not doing it, why would they? So it starts there, and being willing to open that kimono. And so it's not easy to do, but that's what we do. Long answer, but
no, I think it's perfect. And I think it kind of speaks to this other sort of the sense of, how do you build safety when people are not actually together, which has been the case for the past almost year and a half. And how did you maintain the culture while you were apart? And do you think it's possible to have that really strong sense of safety when people are working from home? Is that actually a feasible strategy in private equity, or do you think maybe not?
Yeah. Let me just make one more point. I'm going to come to that, answer that question, but one more point I think is really important as I was thinking about it on this safety and why is it so important? I mean, everybody wants to feel good. That's great. The reason it's so important in my mind is, and a good example is we brought in a VP, tremendous guy, very smart, super smart, but wasn't blossoming, right? You could tell that based on where he came from, he probably had a very big shield in front of him. Right. And so he wasn't really showing us all he could do. We got inklings of it, but he wouldn't speak up. He wasn't present as much as we would like.
Yeah.
And so we didn't really understand the depth of his capabilities as a result. We knew he was smart, we went to hire him and had great experience. But as he became safer, feeling safer, and we nurtured that, kind of feeling, he just blossomed and, incredibly present, an investment committee, we encourage everybody to ask questions and participate, just taking command of on deals. I mean, all the stuff you would want someone to do that he wasn't doing in the beginning, he started to do. And he even said, this place makes me feel really, empowered.
Wow.
And this is somebody who's been in our world, our private equity world, a very well-known private equity firm prior to joining us, for a long time. He's a person of color, and I just don't think he felt safe. And so fast forward now, we have this amazing superstar, right?
Yeah.
Now, he was, a potential superstar when he started, but you have to realize that potential. And why that's important is because we can bring all that out in everybody. Our performance will be better too, right? Our impact for investors, for everything we do. So that's why full circle, it's also very, besides doing, being good and doing good.
Right.
In terms of working from home and COVID, what we did is we started having daily Zoom calls. And so, pre-COVID, we're all traveling, we're all in and out of the office. So we'd have a weekly call, right? But even though we're all supposedly in the office, we didn't see each other connect. We'd come to the office, we had calls, we'd close our door. We'd get lunch together. We're a very friendly group, and reasonably close. But, when we started the daily Zoom calls, everybody loved it because well, one, you feel kind of isolated in COVID, it is a connection. But two, we actually, particularly the junior people, had more connection, if you will, more communication with everybody in the team, including the partners, than they ever had before. And every call from our deal, the deal calls on deals, investments, every topic, everybody was on. So people felt more connected, which was great. Then we also did things like, virtual poker night. We had cocktail things. We delivered food to everybody, and then we'd all kind of enjoy it, that together over Zoom. Then as things started opening up a little bit, we've had outdoor picnics, things like that. So we've tried to do some things. Now we're all starting to trickle back into the office because we're all vaccinated and things are opening up in California where we're based. So I think and by the way, we're super productive. Not only were we more connected, but we had record deployment last year. We managed through COVID, our portfolio through COVID, all via virtual, and our portfolio held up really well. And we raised our third fund during COVID. So we did all those things virtually, which means it can be done. Now, do I believe we should stay 100% remote? Because we're productive? No, because I think you lose that bonding that it could damage your culture, right? In the relationship building. And we've hired people, by the way, during COVID, which means people we hadn't met personally, in person. So, so I think it is really important for our culture and the bonding and the firms itself to have, connection. I think what we're doing is we're going back to a hybrid approach. So we're going in, as people feel comfortable. So pretty much starting the fall, people are already trickling in now. 2 days a week, may go to 3, for sure 2. The difference is I think we're going to be more intentional. We're there. We're not just going to go there and shut our doors, right? When we're there, they're going to make sure we do the things that bring us together. So we're there for a reason, not just show up, right? Yeah. So, and not everybody's excited about that, having the flexibility to do stuff from home, because everybody proved, we can do it, and it's very productive. We'll still probably maintain, frequent Zoom calls as well. So when we're not in the office, we'll still have those Zoom calls.
Wonderful. Now, I definitely know that Brendan, my client who's on the call here, we met for the first time of maybe 3 weeks ago. After working together for a year, we met in person. And now I can definitely feel, although we have been very productive, there was just a different energy about us being actually in the same room. So although I am a solopreneur and Rustin works upstairs and I work downstairs, so we do meet for lunch in the middle. There is very much something about that sense of electricity that you have when you're all together. So I think that makes perfect sense. I'm going to ask one more question and then I'm going to open it up. My last question is back to the SBIC program. What advice would you give to managers who are applying to it for the first time, knowing that it can be a very long process and very it has a lot of different moving parts. What advice would you give to those who are applying for the first time?
Well, I think first of all, really educate yourself about what the both advantages and constraints are. You have to understand what you're getting into. It's not a fit for everybody. Okay. It may not fit your investment strategy if you're going to be all early stage venture or even frankly all equity. It tends to be better designed for some form of credit or interest bearing or income generating assets, along with some equity is fine. There is some new equity programs being potentially launched through the SBA, so that could change. But right now, if we're just talking about the traditional debenture program, I think you just have to really understand there's a lot of tremendous advantages why all of our funds are SBICs. It's long-term patient capital. You get 10-year low-cost debt leverage up to 2-to-1, up to 175 million. So for every dollar private, LP equity capital we raise, there's $2 of low-cost patient debt. But there's a lot of, as I mentioned earlier, rules and constraints attached to that if it fits your strategy, it's fine. Everything we do is kind of consistent with what the program is designed for. Investing in smaller businesses. For us, it's 3 to 20 EBITDA, mostly 3 to 10. And creating jobs and all those things, which is certainly an important thing here for the economy. But if you're trying to do things that are riskier, because if you can't pay the money back, it's a problem, right? To the SBA, right? or if you're doing things that are maybe going to be, you can't do real estate, you can't do anybody who's a broker dealer, you can't finance. There's a lot of, you have to be 100% US, so some of your stuff is going to be in Canada or outside the, more global, doesn't fit, you're not permitted, and so forth. So you just have to understand, the good stuff and the other stuff. Even, your accounting, they have different valuation and different, there's SBA accounting, then there's regular GAAP. So you have to report 2 different ways. You really have to have a different kind of back office capability or outsource it. The biggest advice I would give, so you do that, is to make sure you get the right legal counsel, because navigating the licensing process and understanding what's permissible and not permissible, and do you fit, and what objections you're likely to get, what do you have to show in terms of, getting a license. There's, half a dozen attorneys in the US that specialize in working on, SBIC licensing and fund formation. And so you definitely want to make sure you get one of those, because otherwise you won't be prepared, won't be able to get through it. And then understand it's going to take a long time, and you have to be patient about that. It's a lot of paperwork and a lot of time. We think it's well worth it, but it's, again, not for everybody. And then the other thing to understand is, you think of the SBA through the SBIC program, the whole license thing, as another LP. So they're going to do very deep and broad diligence. So you have to have all your ducks in order, just like you would for a big institutional investor. They even do FBI background checks. So, you have to present track record, infinite detail and references, and you have to have a real team, more than one person, right, with track record and attribution and all those things. So now the good news is for those of you who are diverse, there's a huge focus on diversity and increasing diversity in the program, which there is not. We are one of the few women or minority-owned firms in the program. There's about 300 SBIC firms, funds, and I think there's a handful that are, women or minority-owned or controlled. But they have a huge push to increase that, and it's a sincere push. And so there's still the boxes that have to be checked, but there's going to be a lot more hand-holding and support through that process by the SBA if you happen to be diverse.
I think it should be it's a great time for it. And it should be a really outstanding opportunity. I have done a lot of talking here, and I know we have questions. Oh, Christine just put one in the chat. Is part of your investment thesis providing debt to emerging or diverse owners in the lower middle market? And Christine, did you want to expound upon that, or is that?
Yeah, I was on your website, Jeri. I just wasn't sure if part of your capitalization and start of the company was based on that thesis of receiving the capital, or if part of your business plan and the requirements of the program with SBIC, part of putting money back out with emerging or diverse managers.
Right. So the answer is no. We have always been careful to say we have special interest, but not exclusive focus, and financing women and minority managed or owned companies. We primarily work with we primarily do what it calls, most of you know, sponsor transactions. So we're partnering with private equity funds to back their buyouts in smaller companies. But so we're providing unitranche debt or subordinated debt, and then we do equity co-investments below our debt alongside the private equity funds. But our fund is about 85% debt, 15% equity on average, if you look at across the portfolio. And so we love it when we come across a woman CEO or minority-owned business, but we keep the funnel pretty wide. We need to, because we really are hopeful. We're not an impact fund, right? We like to have impact, and we do it in other ways, which we can get into later if you want. But we're not an impact fund. So there's lots of great small businesses that are owned or managed by women and minorities, but it's still narrowing that funnel. So then we're following where the private equity funds go, right? So and the SBIC program does not require you to. They just require you to focus on small business as they define it.
Got it. Can I have a follow-up question to ask Jeri, if that's okay? So when you started your fund, obviously you've had great track record and institutional background. I think we may know people in common at Prudential, but can you talk about the experience of raising that first fund in conjunction, obviously, with the SBIC program? I don't know how big your fund currently is and if the coverage is fairly institutional. Can you talk about what I'll assume that struggle, right? It was a big, long fundraise, I assume.
Yeah, it was. Look, it's hard. There's no question. Even if you have a good track record, you've got to assume it's not going to be a slam dunk. First you have to put a team together. And if it's not a spin out team, if you're truly a first time team, not just a first time fund, it makes it even harder. And we were a first time team. We had some prior relationships and connections, but we were not a spin out team. It's a lot easier, not easy, but easier if it's a spin out team. If a couple of you work together in a fund and you are leaving to start your own. There's what you have to, when you're fundraising, you have to, when you go to talk to potential LPs, you first have to kind of filter them. Will they invest in a first-time fund, right? That's one of the first questions I'd ask, because if they won't, I'm happy to talk to them in preparation for maybe a follow-on fund down the road. You're always building relationships, but it's not going to happen for that fund. And then will they invest in your kind of strategy? So first-time fund, private credit strategy, lower middle market, and then third filter, some of them won't invest in SBICs because they don't like leverage, right? So you have to say, have you ever invested in SBIC? Are you willing to look at that? We had to educate some investors about the SBIC program and what advantages it offered, which was significant return enhancement for them because of the leverage. Once we educated, they all came in because we offered a levered and unlevered fund when we launched the original fund, and they all opted into the levered fund. Interestingly enough, it's only in our third fund that we just raised that we have a levered and an unlevered vehicle, because we had some that still don't like leverage but wanted to invest in us, so we created an unlevered SBIC vehicle. So it took us a year to get to our first close. It took us 2.5 years to get to final close, so it can take a long time. Now, granted, we launched in 2009 when everybody was, had their head in the sand at that point, or under the covers because of, the financial meltdown. I think in a normal environment, which that wasn't, it would have taken maybe 18 months in total. But you have to have the ability to support yourself through that period, right? And be able to, travel, or in these days get on Zoom calls, but eventually travel to go see all the LPs, etc. And you also have to be careful when you're targeting, if you're going to, CalPERS, big pension fund, they don't write small checks. So, knowing your audience again, going to the fund of funds, Grosvenor, in those days it was Centinela that managed CalPERS Emerging Manager program, who invested in us because they can write smaller checks on behalf of a big pension fund. Family offices are great sources of capital. Foundations, endowments who will look at emerging managers, and fund of funds are good too, that are managing emerging manager money programs for all of the pension funds and other kind of, foundation endowment clients.
I'm going to put our website. I'm an advisor to a first-time fund launch fund. So it is a fund of funds, but it's launched by Cheryl Mejia, who used to head up the New York Common. You're obviously well on your way past Fund 1, Fund 2, but she is speaking to middle market managers in this space because there is such a void for institutional capital, even private capital, to engage in that first launch. And that is the big struggle. When you talk about 18 months, that's short, right? In the world of fundraising, and the extreme capital requirement to keep yourself alive during all that ups and downs of fundraising. And I think that's one of the biggest troublesome areas of getting talented people, in that main highway, because most of the talented people have great jobs right now, right? So for them to step out and be able to really create their own path to be that emerging manager is difficult. So anyways, I'll share that on the chat, and some of you already may know about her and her new fund, but I see a lot of great faces on this call. So thank you for your story.
No, my pleasure. And you're right. It takes a long time. You have to be prepared for that, and and we had the attitude failure wasn't an option, but we weren't going to be dumb. If we weren't getting any positive momentum at all, if we weren't getting encouragement, maybe we're doing the wrong thing, right? So you still have to figure out maybe just we're not a fit for, doing this. But, the good news too, just not be discouraging. Yes, it takes a long time. You have to have your ducks in order and talk to advisors, talk to other funds that have been raised, so that you can, how do they do it, and what do they need? What are the boxes you need to have checked, hopefully, and to be prepared and to be, attract the right capital. It's still a much better time for emerging managers today than it ever was when we started our fund, right? And we're now, since we're just doing the final close this month on our third fund, we're kind of past the emerging manager status. Now we'll be fund 4 for the next one. So we're no longer emerging manager. We're over 800 million AUM in total. So it's, but there's so much more money now going to and focusing on emerging managers, and particularly diverse emerging managers. Definition of emerging managers is different depending on who you're talking to. It can just be fund 1, 2, or 3, so small funds, or it can be women minority-owned funds, and managed funds. So it's, there's huge amount of interest, huge right now, a lot of because of all the stuff that's been going on the last year or two. People are finally kind of voting with their dollars and really focusing, and because it's better results. Honestly, diversity generates better results. There's a real tangible case. It's been proven that we perform. So.
Yep. I cannot say it better myself. Thanks so much for your questions, Christine. And we have one more from David. Can Jeri expand more on the new SBIC program, more compatible with equity investing?
Yeah, I'm not the expert on it. If you want to learn more, I suggest you contact the SBIA, Small Business Investor Alliance, and one of the staff members. I'm sure they'd be happy to let you know more. You could probably read some of the stuff on the website. There's a number of programs being discussed that they're talking about a micro fund, SBIC, which would be a smaller one that would be a little more liberal in its criteria to get a license, but you couldn't access as much leverage. It'd only go up to 1-to-1. They're talking about doing a venture type program, a little more equity oriented, to bring smaller check sizes to earlier stage companies. It's on the drawing board and being discussed. There's legislative discussion, with Congress on that. And then there's just a traditional equity program, which would be, not early stage, but, more equity. That's again in development, but I don't want to tell you more than I know. I just know all those things are on the drawing board and being discussed. In fact, there's been, some Senate hearings on it, or Small Business Committee of the Senate, Congress hearings on those things. Brett Palmer's the CEO of the SBIA's, been all over that. So there's a lot of work going on. I don't know, anything that has to be approved by Congress is, government stuff and all the paperwork that comes after that, even to put all the details in place. It's going to take a while, but they're pretty exciting things going on. So hopefully they will happen.
Awesome. Well, do we have any other questions for Jeri before we head into networking breakouts?
I have a question, Vanetta. Hi,
Sure.
Jeri. It's Brian Bank. Nice to see you again.
Nice to see you, Brian.
Quick question for you. Would you mind just sharing a little bit about your experience fundraising in the virtual environment, and how it differed with regards to engagement with the prospects over the last 12, 15 months?
Yeah, and we raised most of our funds during COVID. So we had launched right before COVID. So we had some meetings, and we've been developing relationships over the years, right? So it's not like we're starting, right? You're always planting seeds that hopefully will bear fruit down the road, which is why you never say no to a meeting, even if you know you're not going to get a commitment. because it's not a fit at that moment. You know, and you never, by the way, while I'm thinking about it, never, when you get a rejection, you get a lot of them. We did too. I mean, you know, we're not always a fit for, we can be great, but we're not always a fit for what they're looking for. But when they say no, and they're usually slow at it, they're not very helpful in telling you why always. But you just have to be very polite about it. Thank you for your time. Would you like us to stay in touch? Because if you are argumentative about it or take rejection poorly, you don't get another shot with them. And we have a number of people that we didn't invest in our first fund that came into the second, or didn't invest in the first and second that came into the third, right? They just have to be ready. And it has to be the right time and right fit at that point. So, you know, it's losing track of where I was going with that now. But you're just talking about more how we, COVID.
More, yeah,
COVID.
you know,
I brought myself back.
In the virtual setting.
Virtual setting. So we launched pre-COVID. So we had some meetings pre-COVID, but then we were just getting started. This was like in January, February 2020. And then we didn't do anything for a few months because everybody put pencils down when COVID first hit to deal with our portfolio and for the investors to deal with their own portfolios, right? For the LPs. But then you know, people were willing and able to get re-engaged. So we started back up and it actually took off. Doing it virtually was so much better. We didn't have all the time. The LPs were more accessible because they weren't busy traveling all over. It was easier to get a meeting virtually than to get a meeting in person. We didn't have to spend the time and money traveling to New York or Chicago or wherever they were and coordinating schedules. So we had, it was really actually easier. Now, because it's a whole new world for most of the LPs, it took them, some of them were not sure if they would be willing to commit if they hadn't met you in person. But we had a number of investors who came in and have never met us in person. But they just do more reference checking, right? They spend more time with you on Zoom. They spend more time talking to people who know you, and you know, it's a small world. You can do it. It'll be interesting to see now that once things open up everywhere, how much the LPs are willing to do via Zoom. And I think it's going to be a hybrid like everything else. I think they're going to be willing and probably encourage first-time meetings, you know, or subsequent meetings via Zoom, and at some point meet in person, right? But maybe not early on.
Yeah, no,
So
that's what I'm hearing also. Thank you.
Yeah.
Wonderful. This has been fantastic. We do have approximately 10 minutes left, so we're going to shove you all in breakout rooms. Use the time to, you know, this is a community. Please get to know each other. We'll bring you back at around 1:29, 1:30 to have a really quick wrap up, and we'll see you guys soon.
Thank you all.
Thank you. All right, I think we're all tunneling back in here. It is 1:31, so I'm officially 1 minute over the time that I had scheduled for this. But I did just want to say thank you again to Jeri for spending this time with us and for giving us this wisdom. I know I got a lot out of this. And as I always say, if I had a good time, frankly, that's all that matters. But I hope you all got a lot out of it too, and also really enjoy yourselves. Thank you so much for coming. And we will be, like I said, this will be our last Emerging Manager Roundtable, but we will be picking up again in October. So fingers crossed that we will have a really great caretaker for our coworkers, so Rustin and I can both continue to be on these calls because we really like them, and maybe our kid will like them. I guess we'll have to see.
Thank you, Vanita. Thank you, everyone. Enjoyed meeting you all. Hi, David.
Thank you, everybody. This is awesome, Vanetta. Thank you.
Thank you all. We will see you in October. Have a wonderful, wonderful rest of the day.
Yep. Congrats
everyone.
again, you and Rustin.
Thank you. Bye.